In this video, I'm going to teach you how to go into evaluating a rental property to put yourself in a position to know exactly what you're going to cash flow after you've included every single expense that is involved with owning a rental property. And many evaluators or evaluation tools that I see out there on the market today, just by random investors that I've encountered, don't take into consideration all of the factors. And I want to make sure that you all have all of the things that you want to take into consideration accounted for. That way you're getting the actual return on investment that you're expecting on the deal. And for those of you all who know how to run these numbers, or you may not necessarily want to know all the specific details, on this very next slide that I'm going to go through with you all, I'm going to go through initially a summary of what I'm going to cover on this entire training, but towards the end of that slide, on the bottom portion of it, I'll give a link for a property analysis tool. The property analysis tool that I use to plug in all my numbers, and it spits out my maximum offer that I should put on that cash flow deal. And I'll also throw in an extra bonus where I'll give you my analysis tool for going in and analyzing a flip, so something I'm going to buy, fix, and resell. Without further ado, let's get right into evaluating rental properties. And first things first is you need to know the rents for your target market. This is one of the key things that you'll need, and in order to make money on a rental property, you need to have rent coming in. So you need to know exactly what that rent is to the penny to know what you're going to get on a month-to-month basis from that property that you're about to purchase, along with the expenses for your target market. And I'm going to go through all of the different expenses, and some of these expenses vary based on the market that you're in. So we want to make sure you understand that as well. I want you to understand the mortgage calculator. Now this is where it gets really boring when we get into all of the numbers and how I use the mortgage calculator to figure out where we're at. And that's why I'm going to give you a shameless plug to use my cheat sheet or my analysis tool. You can get your free analysis tool or analyze my deal tool at the website below, quickcashflippinghouses.com/deal-analysis-tool. Go to that website, and all I ask you guys to do to get access to that is just share our website on Facebook, Twitter, any of the different social media websites, and you'll get immediate access for free. All right, enough with the shameless plugs. And the fourth and final thing is analyzing the deal. How do you go through the analysis portion of it, all the mathematics? And if you can do fifth grade math and follow the directions on going in and evaluating and using this mortgage calculator, you're golden. That's all you're going to need, but I made it even easier than that, where you can get access to my deal analysis tool at that website below. Rents for your market. Here are some key ways to find rents for your area. Number one thing is you have rentalmeter.com. Rentalmeter.com is a great little website that you can go to. You can plug in how many bedrooms, how many baths, the rent that your projected property has, and what ends up happening is it'll spit out all the rents that are around your property, and it compares. It's a tool for primarily tenants just to see how good their rents are in the neighborhood, but it gives you an idea of what rents are for an area as well. So a great little one I like to use to narrow down my rents. Some other ones, checking local newspaper postings, and in the newspapers, most landlords post in the classified ad section. So I'll go in there along with Craigslist Backpage and eBay classified ads. These are some free resources that many investors use to post their for rent ads. A lot of people are moving all of their stuff online as far as marketing is concerned. When you're going to the newspapers, to Craigslist, to Backpage, to eBay Classifieds, you're going to be able to get access to specific areas. And most of these ads, they'll be posted for a neighborhood or a specific cross street. And you can figure out where your property is relative to the neighborhoods or major cross streets within a city. And you can find what other 3-bedroom, 1-bath houses are renting for in that neighborhood, and you can make phone calls to those landlords, see some of the specifics about the property, and make sure it's a right rental comparable for the property that you're looking to get access to and potentially buy, so that you know that your rents are right. And the other thing is, the fourth way is property management companies. You can go in and get a property management company to do a rental analysis. And a rental analysis is just them doing a drive-by and giving you an idea of what that property should rent out for based on their experience in the market. And most of my properties that I purchased for buy and hold, I put in the hands of a property management company. So what ends up happening is that property management company will give me a quick analysis of my deal before I purchase it in the market that I'm purchasing it in, and that helps me to verify the numbers that I've gotten from the three sources above. And you want to make sure all of these things are sort of pointing in the same direction as far as what it's going to rent out for. So these are the four things that you can figure out what the target rent is for your market, and really narrow that down. Very, very, very important that you have that on point whenever you're evaluating the deals. Now let's get into some of the more technical stuff, understanding the mortgage calculator. And again, my shameless plug down there for all of you all who want to use that analysis tool. And the website that we're going to go to is this one right here. And I'll show you how I use that when we get into the analysis portion of it. But this is a great little mortgage calculator website that you can get access to go in and analyze what you're going to need to get from that mortgage that you're getting on the property, or your end buyer's unit on the property, depending on the situation. Number one thing you're going to need to know, or you can solve for on that mortgage calculator, is the loan amount. And that's just what you're into the deal for. Obviously, we would love to have our loan amount cover 100% of the purchase, but not all the time is that going to take into consideration. And what I mean by all the purchase, that means purchase price, rehab, everything. It just really depends on the lender, really depends on your relationship, depends on the loan that you're getting. If you're getting it from a cash buyer, or a cash investor or private money lender, are you getting it from a conventional lender? Are you getting it from a small local bank? What are you getting it from? Who are you getting it from? And what that loan amount will allow you to cover. Second thing is the term of the loan. Is it a 10-year loan or 120 months, 20-year loan, 240 months, or 30-year loan, 360 months? Make sure whenever you're using a mortgage calculator, on this one, I know it calculates based on years, the website that I've given you, but other mortgage calculators that you will encounter will calculate it based on months. So make sure you take a look at that. Just don't want you to get messed up in terms of figuring it out if you're using some other type of mortgage calculator. Sometimes it's years, sometimes it's months as far as term, and that's how long you plan on having that loan. The third thing is interest rate. And with the interest rate, that is just the interest rate that you're able to qualify for based on the lending institution that you're going through. And the fourth thing is the payment, the monthly payment. If I have 3 out of these 4, I can calculate and use the mortgage calculator to figure out the fourth piece that I need in order to analyze my deal, which I'll show you here in a sec. So let's get into analyzing the deal. And our example property is a property that's asking price of $49,900. And let's say the after repair value is $100,000 in this particular example, and rehab on the property to get it in rent ready condition, $10,000. Now, rent ready condition is not landlord or slumlord conditions or slumlord standards. This is safe, clean, and functional. I'm not going to make it the Taj Mahal, but I will make it safe, clean, and functional, making sure that if it were like a HUD property, it will pass HUD standards, and it's even better than HUD standards by my regards. So if you're trying to do Section 8, those types of things, but rent-ready, safe, clean, and functional types of properties. Rental income. The rental income on this property is $900 a month. And then we want to figure out what we want to have as our desired cash flow, which is, let's say, $200 a month. And that's net after all expenses. And you want to be careful, because if you don't analyze the deal based on all of your expenses, I see so many investors analyze the deal, and I'm even guilty of this in the very, very beginning stages of my investing career, where I just analyzed the deal based on PITI, principal, interest, taxes, and insurance. And if I had $200 a month positive cash flow after my PITI mortgage payment, I thought I was good. That is not the way to analyze these deals, because it's really a break-even property at that point whenever you factor in all the real expenses that come along with owning a rental property. So I'm going to show you how to analyze that to make sure you don't make that same mistake in analyzing your deals. So on this deal, we're always going to start out with how we're going to get paid whenever we're analyzing a property to determine what we're going to offer on that property. How we're going to get paid on a rental property is the rent. So our market rent's $900 a month. I know I can get that for my property, so I'm going to plug that number in, and I always look to pay myself first. So I will subtract from that $900 my desired cash flow. That's what I want to pay myself on a month-to-month basis for owning this property. Next thing is property management fee. That's going to be 10% of our rent. And most property management companies are going to charge us 10% as far as industry standard is concerned. So I want to plug that in. 10% of our rent, so that's $90 a month. And for maintenance, maintenance can vary. It can be anywhere from 5 to 10%, depending on what you're doing on the transaction, what you're doing on the property. I like to budget just a 5% maintenance factor, and that's 5% of the rent, so $45 a month. Now, that does not mean I'm going to put $45 a month towards that rental property. That is not the case. What I will do is I will put $45 a month aside in my rental property reserve when I purchase it, when I have that property rented out each and every month, just in case something happens. And if nothing does happen as far as repairs that are needed, then I'm just going to continue to put that $45 a month to the side to handle any maintenance that needs to take place in the future as well. So 5%, you can be a little bit more conservative if you want to put a 10% margin in there. That's fine. The vacancy factor, that's 100% dependent on your market. And what vacancy factor is the vacancy factor is you're not going to have a property rented out 100% of the time. Just face it. And, there's no real way to 100% guarantee this is going to be the exact vacancy factor. But if you get in contact with, let's say, property management companies, for example, your property management companies usually manage 100, 200, 300 different units, and they'll be able to tell you what their vacancy factor is, meaning their units aren't rented out 100% of the time, and on average, there'll be a vacancy rate of anywhere from 8 to even more percent. 8% is roughly 1 month out of the year the property is going to be vacant. So I just plug this one in for that. It's really market dependent, and I take out that percentage. What's the percentage of time these units are going to be vacant in this marketplace? I'll put that percentage out of the rent because I want to account for that, because if the property's vacant, I'm not making money. That means my $200 a month desired cash flow is not going to happen if that property is vacant. So I want to account for that. So even if the property goes vacant for a month out of each and every year, I'm still making $200 a month. And if it doesn't go vacant for each and every month, 1 month out of the year, you know what? I just made another $72 a year on that property. Excuse me, $72 a month on that property. Multiply that by 12. That's a few $100s. So vacancy factor, something you definitely want to take into consideration, along with the collections factor. The collections factor, I usually factor in 10% of the rent on this particular piece, and this is a factor that factors in times where you're not going to get paid. Your tenant is not going to pay you 100% of the time, so I'll plug in 10% on that. Just saying, 10% of the time I'm not going to get my money from my resident over the lifetime of owning this rental property. So I plug in that $90 a month to account for that amount. Now, does that mean that they're never going to pay the rent? No, I'm just going to factor it in for more of a worst case scenario. And I want to factor it in as far as worst case scenario because I've owned rental properties. I know that worst case scenario sometimes does happen. And when it does, I don't want my cash flow to go from 200 to zero real quick. I want it to be $200 a month pretty much a given, no matter what happens, based on the marketplaces and the vacancies and the collections of not being able to collect rent and having to evict tenants, those sorts of things. These are making sure that you're covering all of your bases and protecting your asset or CYA, covering your assets, okay? So next one is that gives you, after you subtracted all of those things, that gives you your maximum payment, PITI, principal, interest, taxes, and insurance. That is $403. Now I need to subtract the taxes and insurance on this in order to figure out my loan amount, which we're going to get to, and y'all to explain why you need that here in a bit. But I need to subtract from that PITI payment the insurance And the insurance on this is $650 a month. So I'll subtract that $54.17 per month. And I'm also going to subtract the taxes. And the taxes are $810 in this particular deal and $67.60 per month, which gives me a maximum payment, PI, principal and interest, of $281.23. What I will do is I will take this payment and I will also take the 30-year fixed rate mortgage that I'm going to be able to qualify for. And let's say in this example, I can qualify for 6.5% investor loan, 30 years fixed interest rate. And what I'll do is I'll take this information as far as payment is concerned, and I want to solve for my loan payment. Remember, I told you, if you have 3 out of those 4 things that we talked about in that mortgage calculator, which I'm going to show you how to use right now, I can solve for the 4th thing. Well, we have the payment, we have the term of 30 years, and we have the interest rate. So I will go directly to that loan calculator, and I'm going to select that I want to, it says, do you want to solve for? I want to solve for the loan amount. Because I have my years, that's 30 years. I have my rate, which is 6.5, and I have my payment of $281.23. And I will calculate, and that gives me a mortgage balance of $44,493.63. Now, what I will do is, based on that loan amount should be my all-in cost on that transaction. So my all-in cost should be no more than $44,493.63. Now, that does not mean that is my offer price, because I still haven't accounted for rehab on the property. I haven't accounted for closing costs and those couple pieces. So what I will then do is I'll take this loan amount or all-in cost. I will subtract my rehab, which is $10,000. So I subtract my rehab of $10,000, and I will also subtract my closing cost on that deal, which is $2,000. And after you subtract that, that gives me a maximum cash flow offer of $32,493.63. With this offer, that's going to be my maximum offer I can make to make a $200 a month cash flow after accounting for all of those expenses. And if you looked at all of that, it was 10%, 5%, and 8%, which is a total of 33% accounted for as far as expenses are concerned. Average rental properties are going to have expenses anywhere between 30 and sometimes 45%, depending on the property, the condition of the property, what's done when you rehab it, all that stuff. So you want to factor in these pieces based on the marketplace to make sure that you end up with the amount of cash flow that you're looking for on the deal. And again, just another shameless plug, at the bottom of this, you can get access to a free deal analysis tool at this website, and you just need to share this link, tweet it on Twitter, just let people know about us, that type of thing, and you'll get free access to it, no cost, and a tutorial video to show you exactly how to use that tool. If we were going to wholesale this deal, we just subtract our wholesale assignment fee, and if we are going to sell this property as a turnkey rental investment, we'd need to figure out what our rate of return or return on investment is on this deal, and based on that, be able to sell it to our investor for the difference or the spread. And I'll have to put together a completely different video based on that, and we'll do it based on this deal. I'll probably have to do it here in the next couple of weeks. But with that said, I want to thank you all for watching. If you haven't liked us on Facebook, make sure you do that. Facebook.com/Quick Cash Real Estate. And until next time, this is G Money, your real estate investment coach. Look forward to seeing you in the next video, and make sure you subscribe to our YouTube channel.